there's been a sudden and, frankly, dramatic event that has absolutely shaken the Indian markets. We're talking about a massive crash in gold and silver that has left investors and jewelers just reeling. So, in this explainer, we're going to break down exactly what happened, why it happened, and most importantly, what it might mean for you. So, a lot of you probably woke up, looked at the market, and just saw a sea of red. This wasn't some minor dip, you know? This was a straight up vertical fall that caught pretty much everyone off guard. Let's take a look at the actual hard numbers to see the scale of this thing. Okay, first up, gold. In what felt like a blink of an eye, prices plummeted by about 30,000 rupees per 10 grams. I mean, think about that. That wiped out a huge chunk of value right off those recent all-time highs. A move that big, that fast, it's almost unheard of. And if you thought the gold situation was bad, just look at silver. It got hit even harder. We saw a drop of as much as 60,000 rupees per kilogram. I mean, that is just a brutal fall. This kind of volatility has sent massive shockwaves through the entire commodities market. Yeah, the industry is calling this a flash crash, and honestly, it's the perfect term for it. It has created a genuine panic situation, especially for jewelers and all the families who are stocking up right before the super important wedding season. But this all leads to the biggest question, right? Why? What on earth could cause a drop this big and this fast? Now, here's where it gets really interesting. You might think, okay, a crash in the Indian gold market must have started in India, right? Maybe Mumbai, maybe Delhi, but no. The real trigger, the spark that lit this whole fire, is actually found thousands of miles away, in the United States. Believe it or not, this whole thing was kicked off by the appointment of just one person, a guy named Kevin Warsh, who is the new head of the U.S. Central Bank, the Federal Reserve. So you're probably asking, how can one person's job promotion cause billions in losses halfway across the world? Well, it all comes down to his philosophy on money. See, Warsh is known to be a huge supporter of something called hard money. Now, in simple terms, a hard money policy is all about making your currency strong and stable. In this case, that means a strong US dollar. And here's the key. A strong dollar almost always means weak gold. They have this inverse relationship. This really gets to the heart of it. Think of the US dollar and gold sitting on opposite ends of a seesaw. When the market hears news that points to a stronger dollar, what happens? Global funds start selling assets like gold and they pile into dollars. The dollar becomes the world's go-to safe haven, and suddenly gold just isn't as attractive. So the news of Warsh's appointment sent the dollar shooting up, and well, the seesaw tipped and gold came crashing down. But that American trigger, that was only part of the story. It was the spark, sure, but there were other factors that acted like gasoline on the fire, turning what could have been a dip into an absolute nosedive. It really was the perfect storm. It was a nasty chain reaction. First, the big global exchange, CME, suddenly hiked its margin requirements. This forced huge global funds to start selling their gold just to cover the extra cost. Then, as Indian traders saw this massive wave of selling, they started to panic and rush to sell and lock in all the profits they'd made from last month's rally. It just kept getting worse. So let's quickly break down what these margin requirements are, because they were a huge part of this. Just think of it like a security deposit you have to put down to trade. Now imagine the exchange suddenly says, hey, we need a much bigger deposit right now. Well, if you don't have that extra cash just lying around, you're forced to sell your positions to come up with it. That forced selling is what made this whole thing snowball out of control. Okay, so with all this chaos and mayhem, we get to the most important question for you, the investor. What now? Is this the time to panic and sell everything you own? Or is there maybe a hidden opportunity in all this wreckage? Let's see what the experts are saying. So, what's the verdict from the people who do this for a living? Well, the consensus is pretty clear, and this is crucial. They don't think this is the beginning of a long-term bear market for gold. Instead, they're calling it a deep correction. Basically, a really sharp, really painful, but probably temporary drop after the price had just gone up so high so fast. To figure out what might happen next, you gotta look at the levels. So gold fell all the way from a high of around 185,000 rupees. It's now hovering just above a really critical support zone, around the 145,000 mark. That right there is the price area that every expert is watching like a hawk, to see if buyers finally step back in and stop the bleeding. Which, of course, brings us to the $1 million or maybe 1,450,000 rupee question on every single investor's mind right now. With prices beaten down this much, is this the buying opportunity of a lifetime? Okay, so what's the playbook here according to the analysts? For people with a long-term horizon, this crazy drop could actually be a great buying opportunity, especially near that 145,000 support level. But, and this is a huge but, there's a massive warning sign flashing. Everyone expects extreme volatility to continue. The market is going to be choppy. This means it is absolutely not the time for risky, leveraged bets like futures and options. You could get wiped out in an instant. And that kind of leaves us with one final thought to chew on. It's in these moments of total panic that fortunes are made. And fortunes are lost. The real challenge is knowing whether staying away from the fire is the smartest move, or if walking toward it will end up being the most expensive mistake you never made.